What do Wile E. Coyote and the Roadrunner have to do with the Vancouver real estate market? Today, we're going to find out. Welcome back to the channel and thanks for being here. Wile E. Coyote chasing the Roadrunner was one of my favorite cartoons as a kid. When I first started watching it, I couldn't wait to see how he was going to catch him. It always seemed that he needed to plan just a little more and acquire a bigger stick of dynamite in order to succeed. It never occurred to me that catching him just wasn't in the cards. But we're not here to discuss my intelligence level as a kid. I promise I gained a few IQ points along the way. Today, I can't help but draw some similarities between the Coyote and the Vancouver real estate market, and not always in the ways you might be thinking. Yes, it's true that many are doing their best and still watching the market get away from them with little hope of ever catching it. But then there are the ones that have their stick of dynamite in the form of a down payment, and they are still drawing their plans, biding their time, waiting for the perfect time to pounce. Those plans include timing the market, paying down debts, and saving for more down payment. Unfortunately, much like the Coyote catching the Roadrunner, things just aren't panning out. Let's break down why this plan may or may not be working. First, timing the market. There are many that believe we are in a real estate bubble, that prices can't go any higher and that a crash is imminent. And why shouldn't they believe this? The media has been discussing its potential for decades. All the while, prices have continued upwards for the last 30 years. Yes, there have been some down years, but overall, if you bought 5, 10, 20 years ago, your property is worth more today than it was when you bought it. Over the last 25 years, Canadian real estate as a whole has had an average rate of return of 5.7% annually. This means that if you were looking at a $500,000 property today, next year it will be valued at almost $530,000. Second, paying down debts. There is nothing wrong with paying down your debts in order to increase your affordability. I have discussed this in a previous video before. However, it depends what the debt is for and what the interest rate is as to whether it makes sense to delay buying a home until the debt is paid off or if a consolidation loan makes sense. Depending on many factors, it may even be possible to roll your debts into your mortgage and pay a much lower interest rate. I would only recommend this under specific circumstances and with the assistance of a financial advisor, as everyone's financial situation is slightly different. And last, the down payment. The single biggest obstacle for people getting into the real estate market these days is saving the hefty down payment. However, some folks are misled as to what they need to save and what they want to save. If you are a first-time home buyer, you can typically get into the market with as little as 5% down. This in turn will come with the requirement to have your loan insured, which adds to the overall value of the loan you're assuming. If you put 20% down, you avoid the insurance costs, which on a $500,000 purchase is about 19 grand. However, some of my clients have gone so far as to tell me that they're waiting until they've saved the 20% for the sole purpose of avoiding this extra fee. The problem with this logic is that the market moves faster than the savings add up. Put it all together and what are the results? Let's look at the difference waiting a year makes to your bottom line. First, that $500,000 property you looked at last year but didn't buy is now worth $528,000. While you saved an extra 2 grand per month for your down payment, you also avoided your monthly payments going towards the equity in your home and instead paid your landlord another 20 grand in rent. All the while, you still don't have your 20% down payment and the insurance fee and monthly payments are now slightly higher for the same property. Now you have two choices. You can stop the bleeding, buy now, and start building your wealth from here, or save for another year. The market will drop, you'll have more money to spend, and your debts will be lower. True, your debts will be lower and you'll have more money to spend, but history has proven that the market is resilient and the additional funds just won't go as far as you think. The lost opportunity cost is greater than the insurance fee, the debt repayment, and the additional down payment saved each year combined. Is buying real estate risky? Yes, there is an inherent risk with anything, some of which can be mitigated with proper due diligence. Though, in my opinion, when it comes to your principal residence, not buying as soon as possible is the greater risk. One thing that's for certain, just like Wile E. Coyote was always devising plans to catch the Roadrunner was doing the one thing that always kept him safe. He ran forward. Sometimes he took a break, but never did he change directions and run into the Coyote's open arms. If you're looking for other tips on how to save for a down payment, check out this next video. Other than that, thanks for watching and have yourself a great day.